Well, good morning. It's Monday. This is the BrightAdvisor podcast. Pat Moran with Brock Brenneman. Brock and I go and handle a lot of the client interaction and the appointments for BrightAdvisor. In particular, thought we'd focus on the market. It was interesting. We did a little bit of a brief update last week. We were talking about gold and the fact that gold has really been rallying. And I thought it was interesting. I read a couple articles over the weekend that China, since the beginning of the year, has added over 100 tons of gold to its reserves. Russia is now the 5th largest holder of gold in the world, and a lot of them feel that this is a preemptive move, that the U.S. is going to lose its ability to be the sovereign currency. And if that happens, the implications for U.S. borrowing and debt and things like that could be somewhat tricky. Monetary policy definitely has an effect on the market, and we saw just with the trade wars and the currency devaluation between China and the United States, the jitters and things that it caused for the market. And I think there's a tendency sometimes, Brock, I was talking to a gentleman last night at a party at a friend's house, and he was telling me that he thinks that the shoe is really going to fall, that the market is really going to go through a major correction, if for nothing else, that he thinks it's long overdue. History repeats itself, and he thinks that there's all these perimeter problems, such as gold, such as the debt, such as the upcoming election, such as political uneasiness. I saw where Trump over the weekend came under fire for a supposed top secret meeting he was going to have with the Taliban in Camp David. So you're a young guy who's got some investments, and you're starting off. What do you think about some of this noise, and does any of this stuff concern you?
So it's been kind of crazy. If you're in like the individual stock game, I feel like it can be a little nuts because it's been super volatile lately, like you said. So it can be worse. For me though, I'm young, so I know I'm not too worried with the day-to-day. I'm looking at more long-term stuff. I'm not like day trading or doing anything crazy like that. So I'm really just looking at a long-term play. But even then, I'm still human. I still mentally look at it, and sometimes you'll freak out as it goes up and down. But that's why there's some other strategies that we do here that can combat against that. So at least if it's been crazy, I have this other portion of my portfolio that's a little more foundational and will last. But we were talking about one stock earlier that, not that we're going to recommend any certain stocks, but we were talking about AT&T, how it's something we've been investing in. And one thing I really like about it is, even though the market's been crazy, AT&T will just fluctuate like a tiny bit up or down. Right. And it's pretty cheap right now, so I never like really worry about, I'm going to lose. What's
the yield on it now?
So now it's around like 5.6%, I think.
That's great.
When we were buying it a few months ago, it was at 7, so even better. Right. But it's been going steadily up, which I love. And even if it has a bad day, it goes down 50 cents or something, which isn't a huge deal. So, and then also we talked about doing dividend reinvesting again and again. But it's nice because as we get those dividends, it just buys more and more stock long term. And that's one that today there was actually some big news too. A big investment company, said, I think they invested like $2.6 billion in AT&T, and they think it could go up to $60 a share, which I think right now it's like $37. So that's huge. So that's a big upside. So to get like some praise like that is awesome. Just something that I've been watching closely.
Elliott Management has a reputation for going in, holding the board a little bit accountable. They want to maybe clean up some of the non-core assets. I believe they've identified about $10 billion in restructuring internally and expenses that they would like to clean up and add to the bottom line. And as I say, the target price is 60. In full disclosure, it's my largest holding. It's been my largest holding for a while, and Brock's been buying it as well. Initially, one of the things that he touched upon, which is a great way investors can get involved with some of these stocks, is in the DRIP plans, the Dividend Reinvestment Plan. And ComputerShare, for instance, is the custodian or the sponsor of AT&T's plan, and you are literally able to go in and buy a couple of shares of AT&T. I think it's $25 or $50 of stock directly through ComputerShare, and then every time dividends are paid on AT&T, and one of the reasons that I told you when you and I were initially talking why I liked it was because of the yield. the fact that the stock had a 6 to 7% yield, and if I could get a couple of points on appreciation of the stock price, I got a stock that could, do 10% between its dividends and its appreciation, and certainly that's been the case, certainly more. But the dividend reinvestment plan then reinvests those dividends into more shares of stock, and it's a great way to continue to add too, because you can add $25, $50. I mean, with my kids in the disclosure department, my daughter has Verizon, 16-year-old, and lives on her phone, and my son has Nike because he's very involved in soccer and a lot of the Nike products. And so instead of birthdays and monies and all these things, years.
So they weren't just trying to make quick money with it.
No, and many of these stocks we buy for the long term. It'll be something probably that they'll get when they come out of college, because we have different monies identified for college. But the reality is they're getting into it now too. Dad, I want to check out my stocks. And I think it's very important from just a parent standpoint, stepping outside that dividend reinvestment for a second, for us to really spend time with our younger kids, younger generation, much like I spend time with you, talking about stocks and different things that you can do and ways to invest. And we have, great conversations. You and I are often, I'll read an article, you'll read something, we'll be batting back and forth, and not that we're recommending lots of stock, it's just that we're into that, and it's a piece of the portfolio.
Yeah, I just have like a small amount of money towards that, I guess, for fun, but also super high growth potential. So I look at it for, all right, when I'm 30, 40, 50 years old, what could these stocks potentially look like? Sure. And it's kind of just for fun. But obviously I'm trying to make money, and right now the market's been good, even though it's been volatile, it has been good. But if it does take a crap, like some people are predicting, this isn't money that, all right, if it goes down 50%, I have to sell and lose everything. Right. So I would not do that if I was in a position where that was my only money, obviously. But,
sure. That diversification is important. To wrap up on the dividend reinvestment plan, there's so many companies that have, dividend reinvestment plans. It's a really easy way to invest, and my kids will, commit 25, 100, I'll throw money in, but it's one way that people can look. I think the other message in what you were saying is it's really important to diversify. And that diversification, like you said, it's money I can afford to experience a little bit more volatility with. I've got other monies in my foundational bucket, which is I'm not doing more of this. I'm just looking for some more consistency, less volatility. And that diversification story really is something that we pride ourselves on to help people, weather the storm and do some different things. We also are firm believers that some of the traditional mantras that have been out there, the buy and pray strategy, the different things like that, we are not as readily running to the to the plate and just taking advantage of something like that. We really are looking at strategic other ways to really open up the perspective and game in front of all the things that are potentially
real quick
available.
Before we wrap up, when you are looking at individual stocks that you're interested in, what are a few of the biggest metrics or numbers that you look at to say, all right, this is something that I think is strong over the next 5 years or something?
Right. Well, first of all, just that. Is it something that I want to own? I mean, Warren Buffett says the best. If I'm buying this today, would I be comfortable owning it for the next 10 years?
Yeah.
That's going to certainly be one of the parameters. Secondly, what is that adding in the way of diversification or value to the portfolio as far as what I'm looking at? Good management. Love a yield. Most people don't realize that dividend yields are great. You can do, these CDs and short-term savings accounts are virtually paying nothing. And you've got stocks like AT&T at 5.7%, good company, that's paying me 5.7% on my money while I'm allowing that thing to grow over the long term. And I can see myself owning AT&T for a long time, much like we talked about, with Intel when it was down in the 30s, and we've done well with that in the 50s now. General Mills is another one who've done real well. Again, bread and butter companies, industry leaders, been around a long time, pay dividends, good management, good track record of historically raising those dividends. Dividends, I think, are a great way for investors to look at a company, because the management, by raising its dividends and paying dividends, I believe is telling the story that things are going well. We're rewarding our shareholders with dividends. We wouldn't be paying out those dividends or raising those dividends if things weren't going well. And so I think that that's a reaffirmation that the company's on track, and I love to see that consistency, 5, 10, 15, 20 years of dividend raising. So some of the things that I look for in that area of the portfolio, and those are going to be more of your total return, blue chip, large company type stocks. As you move down and you get more into the growth type stocks, you're not going to see necessarily as much dividend play as you are looking for appreciation potential. So a couple of things that I dabble in. And at any time I might have 8 to 10 holdings. I know that you're playing with some different things, and for young guys, so I always joke this could be my son, one of my sons. You've done very, very well at plodding away. So what are some of the things that you would advise your generation? You have a huge big part of the population. My baby boomers is obviously one of the biggest. We're retiring every day and will so for the next 10, 15 years. You're starting off. What are some of the things that you would tell a young investor?
So I'll frame it like this. This is what I'm doing instead of, this is what I recommend. I'll just tell you what I'm doing. My goal, I think a lot of people my age, they're trying to find like an extra $100 or $200 a month that they can spend on having fun or doing something. But I think it's way more important to put $100, $200 away for the future. And if you start now, it's amazing what it can do. So what I'm doing is, we're talking about a lot of individual stocks right now, which is fun and it's sexy, I guess. Right. But really, that's just a small portion of
very small,
the money that I put away. It's more just I play around with that a little bit, and it's interesting and I learn a lot. But the majority of the money I would put away would be into like a Roth or something where it's attached to the market and it has it up and down. And then obviously here we do a lot of index strategies, which, without getting into it, has a floor of 0, so I know I'm not going to lose my money, and then you still have upside potential. So I like those things.
What was that one product you looked at last week that had really good performance, and it was I think it was in an index universal life wrapper.
It was in a life insurance product, but the way it works is all the money I'm putting in, like a small portion of it obviously is buying the insurance, and the rest of it is just going into basically an investment side of things where it builds up cash for you in the long run. But that particular product, instead of some others I've looked at that is just like the stock market, which obviously we know is kind of crazy at times,
S&P, right.
It was a little more diversified in like gold and some.
So I think it had commodities, S&P, and some cash.
Yeah, it had different things, and it had outperformed a lot of the other ones I had looked at. So that's just something a little different to put your money into. But I know with that particular product, the worst I could ever do in a year was like -1.5.
Right.
So it allows me to sleep really well at night.
I think in 30 years it had only been down twice.
4 times in 30 years.
And last year was down, a couple.
And it was averaging like 10%. So not only was I getting peace of mind, but I was also getting upside growth. But again, so as a young person, I would just focus on putting that money away every month, treating yourself like a bill. Where you put it, everyone has their own opinion on that. But I think if you just put it somewhere, it's going to be better off than obviously spending it or not doing anything at all. So that would be the biggest thing I would say.
I think it's really important what we preach in our financial workshops with the numerous companies that and municipalities and things that we work with is the ability to budget. Understand where your money's going. What's happening with my cash flow? If you're not understanding where you're spending your money, then you're not going to know where to cut back, where to potentially save, because if you don't have a budget, you're not seeing that. Most of the people just spend. They hope at the end of the month something's left over, and there never is.
Yeah. My one buddy, my one buddy was like, hey, I would like to talk to you about some of this stuff. He's like, just so you know, like I don't make that much money, whatever.
Right.
And we went and looked, and he's plus like $700 a month.
That's fantastic.
I was like, dude, you're doing fine. You're doing way better than most
Right.
people. And he has like very little debt, just some student debt. But I was like, dude, we could do some things here that would be really well for your future. So, it was nice. We got to look at that, and he doesn't really have to spend any more money, just reallocate where he was putting it.
Okay.
And he still has this money left over in case something happens, right, that he can put towards savings. So he had no idea until he actually just looked at it. He thought he was doing bad, and he was actually doing very well for someone that's
terrific.
24 or 25.
$700 for a young guy like a month? That's phenomenal.
His expenses were low, which was great. He was living below his means. So just something like that, it's nice to know. I think it's funny. People, to me, it's very important. We're in this business, so obviously we think about it all the time, but some people just don't even think about it. They're just like, well, I hope when I get my check and I spend all my money that there's some left over. To me, just take a little bit of time out of your month. You don't even have to do it every day. Just maybe at the end of the month to see where you're at could have a really big impact.
So the 3 or 4 things that we would tell you is, number one is you're a bill. You're your most important bill. So the first thing you do is pay yourself, then pay your bills. Don't go the other way around, because paying your bills and then I'll say what's left over, there's nothing ever left over. So pay yourself up front. Number 2 is know your budget. Understand where your money's going. What's happening with my cash flow? Do I need to go out to 5 times a week and have Starbucks at $10 a day? That $10 a day could really impact your future. We always talk about in our seminars, just find that $5 to $10 a day that you can put away, that $300 a month, and invest it at 7 to 10% could be worth $1 million in 30, 40 years. So understand, finding that extra $5 to $10 to invest. Know your budget. Setting up an emergency fund. It's shocking that I just read 68% of people said that they couldn't put their hands on $400 if they had an emergency in 30 days. So having that money, because we all know emergencies happen all the time. So having some extra liquid cash, I think, is really, really important. And then at that point, you can look at some of the things. You had mentioned the Roth. There might be a 401k with a company match. We recommend up to the match. Obviously, nothing more than that.
Why is that?
Well, because we think that taxes over the long term will go up. And this paradigm of deferring, here, because I'm going to be able to pull out my money here when I'm not working, I'm making as much in a lower tax bracket. We're not really finding that happening. We're finding, if anything, this. So if we defer all this extra money, you have a partner in that scenario called the IRS, and you don't control future tax rates. So we know that taxes historically have been considerably higher. We are in the lowest tax environment we've been in 70 years. Taxes are on sale. And we tell clients, especially with IRAs, things like that, or older retirees, one of the greatest benefits is that $160,000 of AGI up to $320,000 of AGI, we can only pay 2% more in the way of tax. And we feel that if taxes just go up 1 or 2% after we reshuffle some of this money with tax money, the client wins. And we know once we have that money, there's some great things we can do once that money's out with some tax-free type strategies that also provide protection with long-term care, critical illness, guaranteed retirement income, and on and on and on. So the 401k, to a point, the free match it's free money. At least take advantage of it. The reality is about half the people in this country don't have access to something like that anyway. So the responsibility is kind of on them, or maybe they reach out and talk to you, or get some good advice. In the interest of disclosure, we are not stockbrokers, we are not lawyers, we are not CPAs. Feel free to reach out to your trusted advisor. These are just our opinions that we're sharing with you. Mine based on 33 years of plus experience, and Brock, really helping me and helping to be groomed to kind of take that next step in this business. For us, we're really excited to have him on board. It's like anything else. These are what we feel are some things that might make sense. If you have a trusted advisor, please reach out to them. We always are in the camp that no one has a monopoly on good ideas, so second opinion sometimes can bring things to light that you didn't know about. And more importantly, we're independent. We do what's in our client's best interest from a fiduciary standpoint, which is the big buzzword now. It's funny, I always thought we were supposed to act in our clients' best interests. And then lastly, we really pride ourselves in taking a look at the entire landscape of different things that are available to you, because I would argue some of the problems that we're having with savings, some of the underperformance that we're having, the fact that Dalbar, that studies investor behavior, says that most people only hold things for 3 to 4 years and substantially underperform, is because they're all taught a certain way, they're all taught to do this, and frankly, a lot of those things just aren't proving that they work real well. Managed money sometimes is underperforming. The buy and pray strategy is underperforming. It's really hard when the market's taking this big dump to stay in there like you talked about with the intestinal fortitude. And most people don't realize that 7 of the largest 10 drops in the stock market from a point standpoint have happened in the last 18 months. Everybody remembers 2008 or 2002. The worst day of the market was just about a year ago. I think it was a year and a half ago, around February of last year. So that patience that you alluded to earlier, especially for any investor, is really important. Anything that we recommend is certainly not to get in today and out tomorrow. And we have a very hard time in this country of short-term, rewarding ourselves and not realizing that there's repercussions in doing that. And we've always said that the dirtiest 4-letter word in the English language is not what you think it is, it's debt. So try to do the best you can to get out of debt. Anything else you want to leave on today?
I think we've said enough.
So again, thanks for listening to the podcast. If you have any questions, please reach out to BrightAdvisor.com. I will mention that we have a lot of seminars coming up. So if you go to BrightAdvisor.com, our events page, we'd love to have you at one of our seminars. We talk a lot about tax planning and different ways to generate tax-free income, protect yourself, and some of the investing philosophy that we adhere to. But we're always happy to help, so feel free to reach out to us anytime. And thanks for listening today. This has been Pat Moran and Brock Brenneman.